I want to address the title of this video honestly, right from the start. Wipe out your family's inheritance is a dramatic way to put it, and for most families, it won't be accurate. But for some families, especially those sitting near certain thresholds, this change genuinely could take a serious bite out of what's passed on. I'm Angela Rose, and today I'm giving you the real, balanced picture of the pension inheritance tax changes coming in April 2027, so you know exactly where you actually stand. Hi everyone, welcome back. I'm Angela Rose, and this channel is where I take headline-grabbing financial news and break it down into what's actually true, what's exaggerated, and what genuinely matters for your family. Today we're covering the Finance Act 2026, which received royal assent on the 18th of March 2026 and confirms that most unused pension funds and death benefits will be brought into the scope of inheritance tax from the 6th of April 2027. This is real, confirmed law, not speculation. But how much it actually affects your family depends heavily on your specific circumstances, and I want to walk you through that nuance carefully today, rather than just alarming you. By the end of this video, you'll understand exactly what's changing, who's genuinely at risk of a significant impact, who probably has nothing to worry about, and what steps are worth taking now. Let's start with the confirmed facts, laid out plainly. This change was first announced at the autumn budget in October 2024. It went through a formal consultation process, with the government's consultation response published on gov.uk in July 2025. And the legislation has now received royal assent as part of the Finance Act 2026. This is confirmed law, taking effect for deaths occurring on or after the 6th of April 2027. Here's the core mechanic. Currently, most unused pensions and death benefits pass to your beneficiaries without inheritance tax being applied because they sit outside your estate. From April 2027, that changes. Most unused pension funds, and for defined benefit arrangements, most lump sum death benefits will be added to the value of your estate when calculating whether inheritance tax is owed. Now, here's where I want to slow down, because this is the part headlines often skip. Inheritance tax is only charged at 40% on the portion of your estate above your available tax-free thresholds. The standard nil rate band is currently £325,000, and there's an additional residence nil rate band of up to £175,000, where a qualifying home passes to children or grandchildren. Together, that can offer up to £500,000 of tax-free allowance per person. And these thresholds are frozen at their current levels for a further 2 years, through to the 5th of April 2030. There are also important exemptions from this specific pension change. Payments to a surviving spouse or civil partner remain exempt. Payments to a registered charity remain exempt. And death in service lump sum benefits, the payout from a workplace scheme if someone dies while employed, are excluded entirely. That exemption was actually widened during the legislation's passage through Parliament to cover non-active scheme members too, not just those still actively employed. This is where I want to be really honest with you, because the title's framing deserves a fair response. According to HMRC's own published estimates, this change is expected to bring around 10,500 additional estates into inheritance tax liability in its first year, with roughly 38,500 more estates paying a higher bill than they otherwise would. To put that in context, that's a real number of families affected, but it's a relatively small slice of all deaths in the UK each year. For most people, especially those without substantial pension savings on top of other assets, this change simply won't move the needle much, if at all. So who does need to genuinely pay attention? People whose total estate, pension included, is likely to sit near or above £325,000 or above £500,000 if the residence nil rate band applies. This becomes especially relevant for anyone with a paid-off or partly paid-off home, meaningful savings or investments, and a healthy pension pot they weren't planning to fully draw down. There's also a less obvious trap worth knowing about. The residence nil rate band starts tapering away once an estate exceeds £2 million, reducing by £1 for every £2 over that threshold, and disappearing entirely at a certain point. Because pension funds will now be counted as part of the estate, some families whose non-pension assets were comfortably below £2 million could find that adding the pension pushes them over that line, reducing or even eliminating that residence nil rate band allowance. That's a real, meaningful risk for wealthier households, even if it doesn't apply to most. I also want to flag something that compounds this for certain families. If someone dies at age 75 or older, beneficiaries already pay income tax on pension withdrawals at their own tax rate. From April 2027, that same pension money could also count toward inheritance tax before it's even withdrawn. This doesn't mean the two taxes fully stack on top of each other without any adjustment, but based on the information currently available, it can still mean a meaningfully reduced amount ultimately reaching your family, particularly for larger pension pots. Let's make this genuinely useful rather than just informative. First, and this is my honest personal recommendation, not official advice, work out a rough total of your estate, pension included, and see where it sits against the available thresholds. If you're comfortably below £325,000 or £500,000 with the residence nil rate band, this change likely won't affect you much, and you can simply keep an eye on it going forward. Second, if you're near or above those thresholds, the period between now and April 2027 is genuinely the time to review your options while you have the most flexibility. That might include reviewing lifetime gifting strategies, understanding how the 7-year rule around gifts works, or restructuring how your assets, pension included, are held between you and a spouse or civil partner. Third, check your expression of wish form with your pension provider and make sure your executors and personal representatives understand that pension funds will now factor into estate calculations, since they'll be the ones responsible for reporting and paying any tax due. Fourth, and I really want to stress this, get a proper calculation done by a regulated financial advisor or estate planning solicitor if your numbers are anywhere close to these thresholds. Every estate is genuinely different, and the interaction between nil rate bands, the residence nil rate band taper, spousal transfers, and pension inclusion is complicated enough that a general rule of thumb from a video like this one simply can't replace a proper personal calculation. Let me step out of reporter mode for a moment and be honest with you about that title. In my opinion, wipe out your family's inheritance is the kind of framing that technically applies to a real subset of families, but risks making everyone watching feel like they're in the danger zone, when most simply aren't. I think that's a disservice, even if it gets clicks. The families genuinely at risk of a serious impact tend to be those with substantial estates, often approaching or exceeding £2 million once the pension is included, where the residence nil rate band taper compounds the pension change significantly. That said, I don't want to swing too far the other way either. For the roughly 10,500 families HMRC itself expects to be newly caught by this in the first year, and the tens of thousands more paying more than they otherwise would, this is a genuine, meaningful change worth taking seriously, not something to shrug off. My honest recommendation is this: don't panic based on a headline, but don't ignore this either. Do the actual math for your own situation and get professional advice if the numbers are close. Quick recap before we close out. From the 6th of April 2027, most unused pension funds and death benefits will be included in your estate for inheritance tax purposes under the Finance Act 2026. The standard nil rate band remains £325,000, with a further £175,000 residence nil rate band where applicable, both frozen until April 2030. Spouses, civil partners, registered charities, and death and service benefits remain exempt. HMRC itself estimates around 10,500 additional estates will face a new inheritance tax bill in the first year, with tens of thousands more paying more than before. For most families, the impact will be modest or non-existent. For families with substantial estates, particularly those near the £2 million residence nil rate band taper, the impact could be genuinely significant. That's today's update. I hope this gave you an honest, balanced picture rather than just fueling anxiety over a headline. As always, for decisions specific to your own estate and finances, please speak with a regulated financial advisor or solicitor, and check official HMRC guidance as it continues to be published ahead of April 2027. If this video helped you cut through the noise, please hit that like button. It genuinely helps this channel reach more people who deserve the full picture, not just the scary headline. Subscribe and turn on notifications too, since I'll keep covering this as more HMRC guidance is released. Let me know in the comments, after watching this, do you think this change will actually affect your family? I read every comment, so let's talk about it down there. Thank you so much for watching. I'm Angela Rose, and I'll see you in the next one.